You know that home equity is important because it's usually a big driver of why someone wants to be a homeowner in the first place. You don't want to just pay your rent payments, you want to actually build equity in something that's of value like a home. But there's one part of home equity that's very misunderstood, and that is that when you get a mortgage, that you'll have the same amount of home equity that you're building no matter what kind of financing that you have. And that's actually not true. So I want to go through in this video with you and show you how to think about it so that you can end up with more home equity, because a mortgage loan officer isn't going to necessarily tell you this, because the focus when you're getting a mortgage is really on eligibility. So if you know the things to do and to look for when you're getting a mortgage so that you can build the most equity as possible, then you'll end up with more. Are you ready? Hi fellow homeownership enthusiasts, I'm Nicole Hamilton and I'm a home ownership and home financing expert. Please click the subscribe button to find out when I upload a new video. Now maybe you think about home equity in kind of a background way when you get your financing, because your focus is really on the monthly mortgage payment. Can you afford it? And that's super important because you have other goals that you need to satisfy, and you certainly don't want to cause yourself financial strain. So you have retirement or childcare or other things that also are goals, and you just want to make sure that you can afford that mortgage. But by not understanding how financing affects your equity, you're frankly losing out on an opportunity to create more wealth for yourself. And also, you could leave yourself open to leaving money on the table. So for those two reasons, building wealth and not leaving money on the table, you want to make sure that you understand how financing affects your home equity in the future. And stay tuned till the end of this video to find out a simple, easy way to check your home equity. So as a quick overview on home equity, your home equity changes due to two factors. The first is your house value. So if it goes up or down, that affects your home equity. And the second is paying down your mortgage. So each monthly mortgage payment is made up of an interest component and a principal component. And each principal component pays down your loan, which reduces the amount that you owe to the bank and increases your home equity. The amount of interest versus principal that you're paying is determined by the type of mortgage that you have, and specifically by the length of the mortgage and the amount of interest that you're paying. And you can see this most clearly in an amortization table. And an amortization table lists month by month how much principal you're paying and interest that you're paying in your monthly mortgage payment. As a general rule, the lower the interest rate you have, the more equity you'll build, and the shorter the mortgage term you have, the more equity that you'll build. Let's look at an example of this. So if you had a $500,000 home and you put $100,000 down, you'd have a $400,000 loan amount, and let's say these are both 30-year fixed mortgages. With a 6% mortgage, after 5 years you'd have $128,000 in home equity, and if you subtracted out the down payment, that would be $28,000 just from your mortgage payments paying that down. Now if you had a 4.5% mortgage, you'd have $135,000 in home equity after 5 years, $35,000 after you subtracted out your down payment, and that would give you $7,000 more of home equity than you would have with the 6% loan. So let's look now at two different linked loans. So we have the same scenario here, $400,000 loan amount, but we're keeping the 5% interest rate the same for both loans. 30-year fixed, after 5 years subtracting out down payment, $32,000 in home equity. This side, $101,000 in home equity. You have $69,000 more in home equity with a 15-year versus a 30-year after 5 years. So you can see how those two factors, the interest rate and the length of the loan, directly affect the amount of home equity you're going to have in the future, right? And then it just builds and builds. We just looked at 5 years, but you could go out 10 years, 15, and you'd build even more looking at those factors. So you want to be aware when you're getting your financing of how it affects your home equity in the future, because then you'll build more wealth, you'll have more money, and you can do more with that money. And remember that home equity is money in your pocket. It's part of your net worth. You can borrow against it or use it as a down payment when you sell your house. So you want to keep an eye on your assets, and that way you can build more wealth and make sure that home ownership is the best investment it can be for you. Anytime you want to check your equity, you can do it with my free report. It's an instant equity report. It's completely free, and you can go to this link and get it today.